It's a warm welcome from everyone here at OMFIF to talk about an area of continuing interest to investors all around the world, but also to the financial institutions that the OMFIF community represents. Transition finance is a topic OMFIF began working on a while back, and it really was, as we look at the 10th anniversary of the Paris Agreement, a recognition that this global partnership that we need to tackle climate change is going to require the financial markets to play their part. Much has been talked about why investors need to become involved and part of the solution on transition finance. The why is clear. This work is really focusing on how. How do we get the job done? The timing of today's discussion is extremely important. It's 10 years almost since the Paris Agreement was negotiated. I remember well the tens of thousands of people, all of us milling around in Paris, and the sense that this was an issue so complex, so widespread, with such uncertainty, that it would be impossible to manage a global agreement. And indeed, the fact that the COP process had been meeting for decades without that result, I think gave everyone a sense of the scale of the challenge. So the first important thing to say is that the Paris Agreement, for the first time, gave us a global framework, one of ambition, in which to think about how countries would develop their own plans, their nationally determined contributions, to start mapping out what was needed to move, as it was called back then, to holding the rising of global temperatures caused by human activity, keep that rise to well below 2 degrees. So as we look at this now, we see the updates from the International Energy authorities. We are not on track for that ambition. So for that, let's, return, I think, to what was wisely said by Charles Darwin in the opening to his novel, A Tale of Two Cities. It was the best of times, it was the worst of times. It was a time of hope, a time of despair. Now, he was writing over a century ago, but I think those words really speak to the moment that we're in at the moment. It is a time where many feel a sense of despair, but it is also a time of hope. And the role of finance is very much driven by fiduciary duty, which cannot be put to one side, however difficult the task ahead. So what do we mean when we use that rather fancy term, fiduciary duty? And I speak myself, as an investor for many years. I spent over a decade at CalPERS, a large asset owner. I spent time at the World Bank on the development finance side, and most recently at Franklin Templeton, a fund manager. So I've been aware of the challenges of thinking about fiduciary duty from all these different points of view. And there's two ideas in fiduciary duty that matter when we're looking at an issue like climate change. And the first is prudence. Prudence is, again, rather an old-fashioned word, but it means care. So investors do not have a choice. Our responsibility as fiduciaries is to make sure that we are being prudent because we're investing the assets of other people. That means we need to understand risks as well as opportunities. But there's another duty that we have under those fiduciary rules, that law, those principles of fiduciary duty, and it's loyalty. That means that our only consideration can be the best interests of the people we're investing for, the beneficiaries of a pension fund, the client asset owner for a fund manager. That's really important to remember at the moment when many sides are pushing investors to not pay attention to climate change or to pay more attention or at a different pace to what makes sense in terms of risk and return. All of that must be put aside. That duty of loyalty is primary. So prudence and loyalty mean also that we have to be able to manage the different requirements for investing for the short term Think of CalPERS as an example. Many of the beneficiaries have already retired. Producing cash is really important, cash in a secure way. However, we also have many young people saving into the scheme. That gives a very long-term part to our fiduciary duty. So it is fundamental to running pension savings of any sort that we're able to manage the short term and the long term. This is not something special or unique or unusual. It's fundamental to the day job of an investor. So that brings me to the next point. I thought it was helpful for us to ponder on a little bit, and that is thinking about what makes markets work. When the Paris Agreement was agreed, as we head to its 10th anniversary, there was this awe at the size and scale of the financial markets. Depending on how you count it, something like $500 trillion swirling around in different forms in the global capital markets. This is very tempting, very inviting, and certainly a pool of funds which public policy, governments can only dream of being able to tap into. So the potential is there. However, just to come back to the fiduciary duty of investors, this is not a cookie jar. This is not a pile of money into which people can dip to take what they might need. This has got to be a transition strategy which is going to meet investors' requirements for risk management and for opportunity, for generating risk-adjusted returns for the short term, for pensions and other cash needs in the short term, but also to grow funds over the long term. And for that, markets need two things. One, information. So it's extremely helpful this morning that we have two people joining us who really are in the information business. But the other side that's needed is incentives. And CDPQ, who is a leader in this field, knows full well that much of the world of incentives is in the hands of government and policymakers. We think about tax credits, we think about carbon pricing, we think about what's happening in the United States at the moment, where there are efforts to remove climate change as a consideration in generating those risk-adjusted returns. So we need incentives aligned. We need the flow of information to allow investors to price that risk and to mobilize capital under their fiduciary duty to their beneficiaries to generate those risk-adjusted returns. Now, there's another idea that I think we need to return to in the Paris Agreement, and that's the idea of the just transition. Some people think this is an issue that got rather forgotten in the negotiations. Maybe it wasn't forgotten, but it has been since overlooked. It's very important that when we're making these transition plans, that there is inclusion, dialogue with stakeholders, by the people who are affected and impacted and whose lives are being changed by what's happening with climate transition. The frameworks that companies are developing and investors have played a really important role in supporting, nudging, prodding companies to come up with transition plans. These must be rigorous, but they also have to reflect short-term reality as well as long-term needs and demands. You know, as Keynes famously said, we all focus on the long term because on the short term, because in the long term, we're all dead. Perhaps as individuals, that's true, but for a pension fund, it's not. Fiduciary duty means taking care of all the liabilities for all the beneficiaries as and when they fall due. And for a large pension fund and for many pension savers, that means thinking in decades, not thinking in quarterly returns. So I think this morning, the agenda touches on all aspects of this debate. It's going to be an extremely helpful discussion, and I'm looking forward very much to it. We have the finance, we have much of the technology. We certainly have the science to understand what's needed. We have a complicated political storm to navigate in some major markets, but we also have other economies continuing to build their plans and working out where public and private finance come. So we've understood the power of the market in transition finance. This is Adam Smith's famous invisible hand, but perhaps what we need to return to is the visible hand of policy and regulation. And we need to find new ways in finance to understand the partnership, not the knocking of heads, that we must build in partnership between the public and the private sector with involvement of stakeholders to make sure that we make progress. So for that, I count myself an optimist on the proposition that an optimist is a well-informed pessimist. So many thanks to OMFIF for helping us all to stay well-informed so that we're better able to play our part. So with that, Sophia, back to you, and I'm looking forward very much to today's discussion.
Hello, and welcome to the launch of this year's Transition Finance Working Group report. The Next Frontier in Transition Finance is the second report to come out of the working group. It examines the priorities, concerns, and opportunities for global public investors within the transition to a sustainable economy. My name is Sarah Maloney, and I'm Editorial Director at OMFIF. Today, I'm going to take you through the key findings of the report and talk about some of the main themes that emerge from the analysis. The Transition Finance Working Group is made up of OMFIF, MSCI, and Moody's Ratings. We've spent the last few months bringing together some of the world's largest public investors to examine their transition finance agendas and their views on developments in this area over the past 12 months. The results of those conversations have been both sobering and encouraging. The working group was first formed in 2024. We held a series of bilateral conversations with global public pension funds to assess the state of transition finance and uncover the risks, barriers, and opportunities in the journey to net zero. These conversations informed a report that published at COP29 in Baku, as seen on the slide here. This year, we reconvened the working group to dig deeper into these themes. We held conversations with pension funds from both developed and emerging markets, and we supplemented our findings with surveys on their investment intentions. We also hosted a roundtable with multilateral development banks at New York Climate Week to talk about transition funding. The report that we're launching today draws on all of these strands to form a picture of the current transition finance landscape and encourage further action in this space. This year's report is split into 5 key areas: an assessment of the transition finance landscape 1 year on, the need for credible transition plans in the companies funds invest in, the role of blended finance in raising climate capital, investment opportunities in adaptation and resilience, and growing awareness of nature-based finance. The picture has changed markedly in the 12 months since our last working group report. In January, Donald Trump returned to the White House, and this set in motion a rolling back of ESG priorities in the US and elsewhere. With the abolishment of US AID, sources of funding took a major hit, particularly for climate needs in developing economies. At the same time, banks and market participants began pulling out of climate frameworks, such as the Net Zero Banking Alliance and the Glasgow Financial Alliance for Net Zero. But the funds that we spoke with continue to recognise the urgent need for action on climate change. As long-term investors, their horizons look beyond the immediate geopolitical environment to the need to provide prosperity for decades to come. In a survey of pension and sovereign funds that OMFIF conducted earlier this year, no fund said that they intended to decrease their allocations to ESG assets over the next 2 years. While there's clearly ample room for funds to do more in this space, it's encouraging that none are planning to backtrack in the immediate future. However, barriers to investing in transition finance do persist. Last year's report identified a lack of data, unclear policies, and inconsistent standards and frameworks as the biggest barriers to fund transition goals. These obstacles were still present in this year's conversations, with unclear policy environment and a lack of relevant transition data both selected as the most important barriers, as seen on the chart here. This year, funds also selected a lack of commercially viable projects as an obstacle, in a reminder that the transition needs to make economic as well as environmental sense. One fund we spoke with noted that it's important to ensure transition assessments are not solely undertaken by sustainability specialists, but that they also involve the investment teams. Investors have noticed the changing attitudes towards the transition. All of the funds we spoke with acknowledged the increased uncertainty as a result of the US cooling on climate. Some also said that they've seen the companies they invest in either delaying or scaling back their net zero ambitions, but they said that this was a tactical change rather than a structural one. Regardless, it's business as usual in the investment intentions of the funds themselves, and momentum and opportunities can still be found. With fewer opportunities in the US, investors are starting to look elsewhere, and Asia is looking particularly attractive due to high demand in the renewable energy sector. A key part of making sure that investors are both viable environmentally and economically is ensuring that credible transition plans are in place for the companies that funds engage with. There's still a long way to go in this area. Of the funds that we surveyed, half said that less than 25% of the companies they invest in have credible transition plans, and 38% said that they were not currently tracking this at all. Where funds are tracking credibility, they want to see a realistic acknowledgement of transition risk in the companies they invest in, particularly in hard to abate or high emitting industries. However, funds say that it's difficult to pinpoint exactly what a good transition plan looks like, and every investment is different, meaning that they have to take a case by case approach. Some investors are making use of frameworks such as the Climate Action 100+ initiative, the Science Based Targets initiative, and the Network for Greening the Financial System to help them assess the credibility of plans. Tools like artificial intelligence are also helping here. But funds say that there's no substitute for direct engagement and active stewardship to gain a deep understanding of how a company is approaching the transition. Blended finance has been part of discussions for a number of years, but it's struggled to really take off. In last year's working group conversations, most investors recognised its potential in assisting the transition, particularly in emerging markets, but they said that there were few realistic investment opportunities available at the time. This year, attitudes towards blended finance were more encouraging, but investors were clear that blended finance is not a silver bullet to the challenges of raising transition capital. All of them had faced barriers to investing in blended finance vehicles, with low returns and insufficient scalability being identified as the most common obstacles. Interestingly, no funds selected a lack of public money as a barrier, and this suggests that cuts to MDB funding have not materially impacted this space yet. Despite the barriers, some of the funds we spoke with have been involved in blended finance deals, and momentum seems to be growing in this space. The OECD calculates that $70 billion in private finance was mobilised through official development vehicles in 2023. But with trillions still required annually for meeting the needs of the climate transition, the value of the deals done through blended finance so far fall way short of what's needed. Part of the reason for this is that risk continues to be a key barrier, particularly in emerging market investments. But the funds we spoke with observed that the perception of risk often outweighs the actual risk involved in these projects. This is an area where the public sector can help. The involvement of governments and MDBs can act as a stamp of approval, which makes it easier to crowd in private capital. They can also provide first loss guarantees and absorb transaction costs to bring in a wide range of stakeholders. All of the funds agreed that blended finance does have a role to play in financing the transition, and not just in emerging markets. While it won't solve all of the problems faced by investors, it can play an important role in reducing the perceived risk of projects by involving both public and private capital. Investors are increasingly scanning their portfolios for exposure to physical climate risk, and they're beginning to find opportunities in the need to build resilience. Adaptation and resilience is a relatively new area of focus for investors. Mitigation has historically been a priority, but with severe weather events becoming more frequent and time running out to limit global warming to 1.5 degrees Celsius, attention is turning to how to adapt to a changing environment. This means that there's a substantial investment opportunity, especially in relation to infrastructure, agriculture, and real estate. Investors are particularly interested in companies providing climate adaptation solutions in technology and weather-resistant systems. But they need direction from governments, and they need a pipeline of infrastructure projects to invest in. They also need more data on physical climate risk, which they said is particularly hard to come by in emerging markets. Above all, focus is on risk. Ensuring that portfolios are prepared for a changing climate is becoming a standard part of risk assessment process. Some investors have been doing this for a while now, particularly in the real estate sector, but others are only just starting. The final theme of this year's report is nature-based finance and biodiversity. Investors are recognizing that a significant amount of economic activity depends on goods or services provided by nature. Some funds are beginning to explore investing in nature as an asset class, and they're investigating nature-based solutions that seek to protect or restore natural ecosystems. Funds are relying on standards such as the Task Force on Nature-Related Disclosures, which provides a structure for investors to assess their impacts and dependency on nature. But more data will be needed to fully price in the risk to investments. This growing awareness has not yet translated into tangible action. None of the funds that we spoke to have started actively investing in nature-based finance yet, but most said they are waiting for more information. While they are watching the space with interest, we are some way off nature being a primary driver in investment decisions. The conversations we had as part of this year's working group provided an encouraging counter to the gloomy headlines that have appeared in the last 12 months. While some in the financial sector are rolling back on their climate commitments, pension funds are in it for the long haul. Similarly, the US withdrawal from the space is creating opportunities for other regions to step up, in particular Asia. But pension funds can't finance the transition alone. They need governments to build project pipelines and provide incentives for private capital to invest. A key area for this investment is adaptation and resilience, particularly in infrastructure projects. Finally, while assessment of nature risk is at a much earlier stage than climate, investors are watching this space keenly. In the words of one of the funds we spoke with, a world that tackles climate change, is politically and socially stable, that lifts countries out of poverty and has well-distributed, inclusive economies is the world with the best economic growth. Thank you very much for listening. I'll now hand you over to my colleague Sophia for the panel discussion.
Thank you so much, Anne and Sarah, and good afternoon, everyone. And it's always inspiring to hear from you. Thank you for your leadership in the sustainable finance community and for your continued support of our work at UNFIF. We'll now move on to our panel discussion, and we'll unpack some of those findings in more detail and hear how investors, data providers, and credit assessors are putting them into practice to continue the work that you, Anne, and other leaders have started even before 2015. Just a quick reminder to everyone joining us today, please do keep adding your questions and reflections in the chat. I'll be keeping an eye on them throughout, and we'll bring some of them in the conversation at the end. I'm absolutely delighted to be joined by three fantastic speakers today. Adriana Mendes, Director of Stewardship and ESG Integration at CDPQ. CDPQ has also been a member of the working group, so we are delighted to have Adriana with us today to launch the report. Rumi Mahmoud, Research Director at MSCI, and Vincent Alileur, Vice President and Senior Credit Officer at Moody's Ratings. Thank you all for being here this afternoon. Let's start with you, Rumi, if I may. The report highlights the growing importance of resilience and adaptation alongside mitigation. From your vantage point at MSCI, what are you seeing in the data? How is the share of assets under management being allocated between mitigation and resilience?
Sure. So, most climate capital, I would say, still goes to mitigation, and that reflects a very long history of sort of decarbonization targets, net zero commitments, clean energy strategies, And so, investment still focuses almost exclusively on mitigation, but now, of course, it's starting to share attention with adaptation and resilience. But just to set the scene a little bit, if we look as of the end of October, in the public listed space, climate-themed funds held around $625 billion in assets, and that reflects double-digit growth and that investor confidence that the energy transition can deliver both returns and impact. Yet the vast majority of capital in this pool still targets emissions reduction rather than climate adaptation. And then if we look at, let's say, the climate project finance space, we find it's kind of the reverse, where, well, actually, more of the same, actually, more extreme in the sense that 95% of total climate project finance actually still goes to mitigation, with around 3% going to adaptation and resilience by our assessments. And so, private capital remains quite essential, but governments and sort of development finance institutions, they continue to dominate, I would say, the adaptation finance space, where if it's funding flood defenses, water systems, and resilient infrastructure, that typically is rarely rarely fits the mandate of listed equity investors, let's say. And so in contrast, public market instruments tend to reward mitigation outcomes such as lower emissions, while the economic value of resilience, avoided losses, operational continuity, and social stability remains quite under-recognized. And just to conclude, the bridging of this divide has become a pressing challenge for markets. As physical hazards are growing, more frequent and more severe, investors and companies are being forced to confront how this exposure translates to real financial outcomes, and the line between physical and transition risk is starting to blur, I would say.
Thank you very much, Rumi. That's quite interesting, and I think it adds a lot of nuance to the findings of the report. Adriana, if I may come to you now, CDPQ manages over $400 billion in assets with a long-term mandate. The report describes a real dilemma for investors like yourselves, balancing conviction in the long-term transition with the reality of near-term political and market headwinds. How is CDPQ navigating that tension in practice? Has it changed how you approach portfolio construction or capital allocation?
Yes, thank you so much, Sophia, for the question and for having me here. So how we're navigating this, I love a quote from our CEO. We have it on our sustainable investing report this year that says, it's when you have headwinds that your convictions are tested. For us, that's been our motto this year. We actually released a climate strategy back in June, where we're doubling down on our commitment to climate investments. And our climate strategy consists of two pillars. So we have on one side decarbonization, and on the other side climate solutions. So our objective, our final solution objective is 400 billion in 2030 of investments in this climate strategy. So what does that mean? It means that we're through our two pillars, so decarbonization and climate solutions, we want to, on the decarbonization pillar, what we want to do is help our companies really drive the transition of the energy systems across the globe. So what we want is that they have targets that they integrate the decarbonization in their business model, or that they have a transition plan in place. And we have different criteria to meet that. For sure, SBTI, for example, is our golden standard. But we also are very much aware that some sectors are very difficult to decarbonize. And that's why we want them to have at least some targets and at least a net zero ambition in the long term. On the other side, we have the climate solutions, where what we're doing is investing in 4 different types of assets. So low carbon assets, nature-based solution, and what's new, it's what's very much aligned on the report that was presented earlier. It's adaptation and resilience. For us, that's something very new, but it's very much we're very much aware that the physical risks are becoming ever more critical. So what we want our companies is to really take that into consideration and adapt. And finally, we also have a new category, which are enablers of climate solutions. We don't expect this to be a very big bucket of investments, but this is how we're doubling down at CDPQ. And we, you know, I was listening to Anne and very much aligned with what she said. We know that there's the incentives need to be aligned, that policies need to be aligned. We understand that governments need to juggle priorities, and what we're seeing is that that we need to influence our companies throughout our investments, and we're very much committed to that with the new climate strategy.
Thank you very much, Adriana. Also for going back to what Anna said, which I agree was very powerful and extremely interesting. Vincent, if I might come to you, the report that we're launching today shows that investors remain committed to the transition, and it's extremely good news. How is that showing up in companies' transition plans and disclosures? And what indicators does Moody's use to judge whether those plans are both financially and operationally credible?
Yes, thank you very much. Hi, everyone. Indeed, the report, that's one of the very welcome conclusions from the report, is how there is still a continuous focus from investors, irrespective of the climate, the political climate around, and there's also clearly a continuous focus of issuers on transition. In fact, mostly because, as we see on the day-to-day, credible transition plan can support access to finance by allowing that better engagement with investors, which is very important. And we see as well an increasing level of disclosure, because first and foremost, especially companies have to. Scrutiny is rising. We expect regulators and investors to continue to increasingly demand that companies articulate entity-level transition plans, and this plan will need to be well-defined and business relevant enough to explain how the companies intend to achieve decarbonization. At the moment, as of June 25, there were 33 countries which were in the process of adopting all or part of ISSB standards in the regulation. Plus, if you add the 27 EU countries which have started for large companies to report under CSRD, that's 60 countries where companies, large companies at least, are expected to start reporting on transition plans. That's a very significant move, and indeed we're going to see much more of that. But the disclosure element is only, of course, very partial, because companies are first and foremost disclosing because, first of all, we want to implement a transition plan because it makes economic sense to them to transition. And that ensures that the momentum will keep on, irrespective of the political context. So that's very reassuring. On the other hand, as you were saying, faced with a rising number of transition plans, including quite a few which are only limited in their detail because of commercial sensitivity, we expect investors, especially those which, unlike La Caisse, cannot engage directly with companies, we expect them to be somewhat confused as to the level of ambition or efficiency of a plan. And that's why we expect companies to increasingly turn to external validation. And Adriana mentioned SBTi, but like our own N0 assessment, for example, in order to facilitate that engagement with investors. Because disclosing a plan is not enough. Companies need to be able to convince investors that their plan is ambitious and it is credible. And by credible, I mean through assessing from various angles, being able to highlight how their ambition can be actually achieved and how likely it is to be achieved. Mm-hmm. And the way we do it at Moody's is that we start by measuring the strength of the ambition of the company's objectives. So we like most people, we use benchmark derived from the IEA and other recognized scenarios. We derive a certain temperature alignment between 1.5 degrees or all the way to above 2.5 degrees. And in order to make all these objective comparables, and so that's important, but that's far from enough. Of course, what you want to understand as an investor is the likelihood of achievement of a transition plan, its efficiency, and in order to understand the credibility. To do that, we look at the actions that the company contemplates in order to achieve that transition, scope by scope, term by term, of course, expecting a higher level of precision in the short term than in the long term. but assessing the likelihood of implementation of each and every action and the likelihood of their impact. And that gives us a way to actually quantify in a very precise manner how effective a plan can be. And we do that from a technological, a financial, and a commercial aspect. And because we are Moody's, we turn all of that into a score. That's what we do. But to be credible, what we have seen, in fact, by looking at the plans which we have looked at over the last couple of years, where we have launched this service. What we have seen that what they have in common is, first, they are very well clearly communicated, and that means not only using the right benchmarks, the right KPIs, but also designing the plan to involve all stakeholders, from the employees all the way to the suppliers, in order to achieve a common effort. They also need to be business relevant, which means granular in the intended action, fully costed, fully integrated into the business strategy. That means considering the impact of transition in a concrete manner from all the aspects of the company's business, from the investment, of course, but also from product formulation all the way to supply chain incentives. And as a result, we see that these plans are very much not only about risk, but very much about opportunities. Yes. And the last thing which is important in the way we have assessed the credibility of plans, they need to be adaptable. I mean, both through the governance, but also through their very construction. I mean, we have yet to see a plan which is fully developed to 2050. And I suspect that plan even may not be the most credible. And even if it was, then basically SSE will need to be able to evolve and adapt to business cycles. And so that's all these features are what we have seen in the most credible plans.
Thank you, Vincent. It's very good to hear of the tangible steps that you're taking at Moody's to encourage organizations and support them in their transition plans. Adriana, I have another question for you. You mentioned earlier on something that is also one of the findings of the report, which is that there is really no substitute for close engagement with companies on their transition planning. And you explain how you work very closely to them to make sure that things happen. How does CDPQ approach engagement with portfolio companies that might be scaling back or perhaps delaying their climate commitments?
Yes. So, I mean, this applies mainly to private companies, and you know, I'll say two things. First, we don't see a lot of scale back. What we see is that they're not disclosing as much as before. So the concept of greenwashing, which probably you have heard, companies are still advancing their transition plans. They're still very committed to climate change and adaptation. So what we have observed is that they're just working silently towards their objectives. So with the ones that we see that they're still continuing, but we still engage. We're a very we're a long-term investor. We have companies that we have under our control or co-control with like-minded investors. So with those companies, how we engage is through the board. We have seats on the board which provide us with direct influence on the management of the company, and that's how we influence our control and co-control companies, which are mainly in the infrastructure space. So we have some companies there which are in the natural gas space, for example. Mm-hmm. So that's how we exert influence through that. With the other companies which are also private, we engage with them either through direct engagement with the company and others, and on our public equities portfolio, we exert our shareholder voting right very seriously. We have shareholder voting directives that we exert very seriously on regard to climate change. So this is how we engage with our companies.
Thank you very much, Adriana. Romy, we heard Sarah in the presentation about some of the findings of the report earlier mention that we're seeing a flow of climate finance towards Europe and especially Asia. From your perspective at MSCI, what do the data tell us about these reallocation?
Sure. So I'll start by saying, the lion's share of climate finance, if we take sort of the public space, climate-themed investment funds, the lion's share is still allocated to the US. So if we take kind of the aggregate kind of universe, and that's partly a reflection of the fact that the US is the largest market, and so it's a reflection of kind of benchmark allocations, if that makes sense. But from the beginning of this year, we have been seeing a clear regional rebalancing. So we're seeing that Europe and Asia are now taking sort of more inflows of climate-themed investments, with Europe's share of assets in climate-themed funds on average up by 8 percentage points, and Asia Pacific's up by 7 percentage points since the start of the year. And at the same time, the share in the US has fallen by 12 percentage points. I will caveat by saying this isn't just a climate investment thing. In general, we know in the market that there's been sort of reallocation out of the US, climate investment or otherwise, and so but it's just that it's been a bit more pronounced in the climate investment fund space, and so we think that this reflects two complementary forces. Firstly, Europe continues to offer sort of policy coherence and regulatory certainty, as well as sort of deep financial markets that are green. And meanwhile, in Asia, we're seeing that this is the sort of fastest growing destination for a lot of opportunity, and in particular on sort of clean energy, clean transportation, and infrastructure. And if we just take kind of one stat, China alone now dominates with 97% of global renewable energy patent filings, so underscoring its role as a sort of a center of clean tech innovation. And so, we view this shift as both opportunity and signal. I think it reflects in general diversification of climate investments, and investors sort of seeking regions with scale, policy support, and growth potential, but it also exposes sort of the unevenness of the geography when it comes to transition. And I think ultimately to sustain this flow, investors will need harmonized disclosures, taxonomy alignment, as well as comparable data across jurisdictions.
Thank you, Romy. Vincent, how is Moody incorporating adaptation and resilience, which we heard about when Sarah did the presentation earlier, into your credit assessments? What does that look in practice, and especially for the sectors most exposed to climate risk, really?
Yeah, no, thanks for the question. It is actually really, really relevant, and through many sectors and through many angles. I mean, we have published extensively on the topic because we see that very much as a rising importance. And it has, of course, from a credit point of view, multiple cash and profitability impact, both in the short and the long term for all categories of issuers. The point is that globally, event-driven losses are rising. To give you an idea, in 2024, natural catastrophes caused more than $300 billion worth of economic losses, of which only 57% were insured. So there was a 43% uninsured gap, which of course means net losses for the people who basically are incurring those costs. And that protection gap is not new. It's decreasing slightly, but it's also bifurcating, with emerging economies facing the wider gap. Insurance protection gap can exceed 90% in some highly exposed, densely populated region of Asia, Latin America, or Africa, where there's low insurance protection. And part of the protection gap is also due to insurability. That's a growing concern. So the event risk, any event risk, irrespective of your insurance status, is going to create some liquidity requirements and liquidity disruption for issuers affected. By issuers, it's not only companies, it's also banks, it's also insurance companies, it's also local governments and governments. And of course, the greater the disruption, the more intense the liquidity needs. And of course, uninsured losses are the net call on the company cash position, and they could compromise the debt repayment of a company. But you have also to think in a wider consequence. in terms of asset prices, infrastructure, and government budget at all levels. In its short-term scenario, the NGFS, the network of central banks, estimates that a combination of extreme weather events and policy stagnation over the next 5 years could result in some significant GDP shocks, for example, of potentially 5% in North America and Europe in the year of the shock, followed by the slower recovery. And of course, that is an unevenly spread issue. In emerging market, it would probably have a higher vulnerability. It would be even more. It could be potentially up to 12% adverse GDP shock in Africa. And of course, as the losses from climate event rise, especially in high-risk areas, insurers may raise premium, limit the coverage, or withdraw from the market, raising the risk of instability, and that will transfer the credit risk to other parts of the economy through, for example, reduced property values or tax revenues or increased reliance on government support. So how do we assess this? I mean, in order to assess that threat, we conduct case studies to evaluate the potential consequences for a region or the economic actors of potential events. For example, and you can find that on our website, we developed with our catastrophe modeling colleagues at Moody's RMS a study on the impact of a Force 5 hurricane to hit Florida more or less now in the fourth quarter of 2025. This could have resulted in up to $200 billion worth of damage, of which we think that only 54% would have been insured, with consequences on insurance premium and hence insurability, but also on house prices and on, which basically means as well on banks and local financing system, and also on local and federal budgets. So you can find all the details. And what we see, and that's of course just one example of the case study that we do, but we see increasingly many companies doing exactly the same, using climate modeling tools to assess their exposure, including through their supply chains, to identify the areas of resilience where they can improve. And of course, we engage with our rated companies and we discuss their findings. Typically, these findings are not public. And in fact, more generally, the adaptation and reliance investments don't have much publicity. And of course, we have these engagements according to the level of materiality that we think the company is exposed to. And that is very important.
Thank you, Vincent. Romy, I would like to ask you a forward-looking question, if I may. The report identified and called nature the next frontier for transition finance. How do you think better data and disclosure help investors integrate nature-related risk and opportunities into mainstream finance? Sure.
So I think, once upon a time, financial markets, only cared about financial data, balance sheets, cash flows, and, earnings per share. But I think today investors are realizing that perhaps, nature itself, might be a balance sheet item, without healthy soils and stable rainfall patterns and, intact ecosystems, perhaps entire business models, can start to unravel. And so I think we're at this, inflection point now where nature risk is starting to become measurable and therefore, investable. But that being said, I think the truth is that nature data today at large is still where climate data was, say, 10, 15 years ago. It's still largely fragmented, inconsistent and difficult to translate to financial terms. We don't have a single unifying metric like tons of CO2 that captures the complexity of nature. For each ecosystem service, you'll have a different unit, whether it's water filtration or kind of flood regulation. They'll have its own data sets and scientific uncertainties. And the other major gap that remains is traceability, right? I think most institutions still don't know how nature risk travels through their value chains. A company might look low risk on paper, but they may source materials from areas of, say, severe land degradation, and that's where the hidden exposures lie. And so at MSCI, we're starting to see the shift through the data in the sense that we're now able to map nature dependencies across thousands of listed entities, to identify how companies rely on ecosystem services, whether it's water, pollination, or carbon sequestration, and ultimately, sort of the idea is that by combining satellite imagery, spatial data sets, and company disclosures, when we can now quantify where corporate operations overlap with ecosystems under stress. And so these geospatial insights in time can now be translated into financial risk indicators that investors can actually act upon. And so better disclosure and data sort of standardization with frameworks such as TNFD, I think will be critical, and ultimately they will allow investors to compare exposures, assess dependencies, and ultimately be able to integrate nature capital into mainstream valuation and credit models, and that will then result in a clearer picture of nature-related financial materiality.
Thank you, Rumi. That's very interesting, and definitely something to keep an eye on, as it seems to be developing in the right direction. Before we move on to questions from the audience, I have one final question for each of you. If you could think of or highlight one development that you think would make the biggest positive impact on accelerating transition finance, what would it be? I know it's a bit of a difficult question because I'm sure there are a lot of things that could make a difference, but if you could think of one, what would it be? Maybe Adriana, starting with you.
Sure. So I think, we talked about incentives aligned. So I think that would be a good one, of course, depending on the context of the country. But just having incentives from government, being clear about those incentives, because the world is very much chaotic right now, and so governments change a lot. So maybe having some kind of stability would be welcome. Another thing would be for financial institutions to maybe adopt climate strategies that are similar to us, but are based on their context as well. So it would be good if we could have more collaboration and we do, but we could still do more in order to align our own climate investment strategies.
Thank you, Adriana. And you, Vincent, can you think of something?
Yeah, one of the maybe most cost-effective solution would be to improve the funding of nature-based solution like mangrove restoration, rainwater harvesting, and this type of thing, which sometimes lack a business model, or maybe are not as obvious as a business model, or just don't have really a good market because of the scarcity of transactions. And in fact, if there were more transactions, there would be a market being created for this type of assets. But there are quite a lot of potentially easy and accessible solutions which could be nature-based, which are looking for financing at the moment.
Thank you, Vincent. And Rumi?
Sure. So I think one development that could make the biggest impact is, treating resilience as an opportunity, not a cost. I think once investors and capital markets at large see that, building sort of climate-ready infrastructure and supply chains and communities can drive long-term growth, and not just protect against loss. That's when I think, transition finance will scale naturally, and it's when resilience, becomes synonymous with value creation, and that's when the real acceleration, will begin.
Thank you. I have a few questions from the audience now, and I will read that to you, and then we'll see who's best placed to reply to them. This first one looks back at an answer that you gave earlier, Rumi, when you said that the lion's share of climate finance has traditionally gone to the US. We're now seeing a big inflow to Europe and Asia alongside a sharp decline in the US. Do you think this is a temporary change that can be reversed with different political priorities, or has this led to more permanent changes?
Sure. It's difficult to say if it's, permanent or temporary. I did caveat the answer mentioning that, in general, you look at investment and fund flows, regardless of whether it's, climate or sustainability kind of oriented. There's been an outflow out of the US into Europe and Asia this year. So it's part of a broader capital reallocation that we're seeing in markets, and it's just that within climate funds we're seeing that it's been a bit more pronounced. So you know, I wouldn't say it's a permanent thing. You know, US is still the largest market, you know, in the world. You know, there may be certain sort of political stance changes, but still, it has the the largest and deepest kind of most liquid capital markets. So I would say, you know, yes, if the sort of if the sort of the appetite changes, and if this the kind of the opportunities arise, naturally capital will flow back. And again, I'll caveat by saying the lion's share is still in the US. So even though there's been some slight reallocation, the bulk still is there, and I think will continue to be there.
Thank you, Rumi. And we have a question for you, Adriana. I was surprised that we were almost getting to the end of the meeting without mentioning AI. So this one says, AI promises real-time insights into climate and nature risks. Do you think investors are ready to rely on those tools for material decision making?
I think it's early days. We're testing internally AI tools, but I think it's early days. I mean, we've all heard different, you know, news around the world about the AI hallucinating answers. So we're very careful about that. We're still very much relying on just more basic tools such as you know, the co-pilots, the ChatGPTs of those. So just relying on real reports from either consultants, companies, and then our own take, and then digging ourselves a little bit more information. So I think it's early days, but we're testing them. I think it also depends on the portfolio. So I mean, for public equities, we rely a lot on the data, ESG ratings, so the Moody's, the MSCI, the ITES, etc. So on the private, we're very careful because we don't know. It depends on the type of data. So you know, having external verifiers for us is still very, very important. So I guess so. Yeah, again, it's early days.
Thank you, Adriana. Rumi, Vincent, do you have any views on this topic? Although you're obviously not an investor.
Sure. So I mean, you know, you had the final question on sort of nature, and I mentioned, you know, this challenge in sort of translating kind of nature risks to financial kind of metrics and identifying hidden variables. And I think this is where, you know, AI is becoming quite transformative, you know, in the sense that we can now use AI to analyze satellite imagery and natural language data, link that to corporate disclosures and trade flows and spatial data to then detect hidden dependencies and impacts. And so, for instance, you know, AI models that we're using can now, you know, identify deforestation patterns linked to agricultural supply chains, or predict, you know, future water stress near industrial sites. You know, I will caveat by saying AI doesn't eliminate the uncertainty, but it does accelerate our ability to connect the dots, you know, between nature systems and financial systems. And in time, that's what will make, you know, nature-related signals more, not just more measurable, but also investable.
Thank you.
Yeah, just to complement that, yes, indeed, I was alluding to models before, and how we perform modeling. Quite a few of our clients do perform modeling as well, and AI will help on the modeling. I just wanted to have a quick light note on saying that for weather patterns, real-time investing is already too late. You need to look far ahead. So it's all very fine, but we definitely expect the models to keep on improving thanks to that.
Thank you. Thank you very much. And thank you to the audience for those very interesting questions. Well, I think this brings us to the end of the session. It was extremely insightful, very helpful for me, and I hope the audience and yourselves enjoyed it. I have a few takeaways, and I'm sure everybody will have their own, but it's very good news that investment in sustainability-related projects is not tracking back, and we're seeing investors continue to be interested in it despite any political headwinds, but because it does make business sense. The importance of disclosure, it's something that all of you have mentioned. The importance of working closely with companies that you mentioned, it's something very important, but was also one of the findings of our report. Incentives, Anne mentioned them in the very beginning, and yourselves think they are needed and extremely important. Rumi, you said something very powerful there when you mentioned that resilience should be considered as an opportunity, not a cost. And I think it's very important. And finally, how AI can help with the data issues and the data gaps, not only when it comes to nature and biodiversity, but across the board. So a huge thank you to all of you for taking part in this important conversation. And I also want to say thank you very much to Moody's and MSCI for supporting the working group and for being a partner alongside. Your intellectual contribution was extremely important to come to publishing this report, and we are extremely thankful. So the report is now available on the OMFIP website. I hope you will read it, the audience will read it, and you'll share it, and we'll keep talking about this important topic. The Transition Finance Working Group will look at 2026, and we hope to continue the stream of work well into the future. We look forward to updating you on what comes next. But for now, thank you for joining us, and I wish you all a very good rest of your days.